When considering investments, it may appear intimidating. However, it's important to recognize that there are numerous accessible avenues to start your investment journey. The earlier you start investing, the more time your money has to grow. Let's delve into Charlie Munger's insights on commencing investments with a small sum of money. Welcome to Nova Society, the top-notch finance channel for your money matters. Join our community and unleash your financial potential. Charlie Munger has always been vocal on his insights in the realm of investment, where he elaborates on his strategies for achieving a 50% annual return on small investments. Munger's insights are invaluable, particularly for those aspiring to accumulate significant wealth. While the commonly held belief suggests that substantial capital is required to generate profits, Munger argues that the initial investment needed for achieving high returns may not be as substantial as commonly assumed.
As a little boy, that the opportunities that were important that were going to come to me were few, and that the trick was to prepare myself for seizing the few that came. This is not the attitude they have at a big investment counseling thing.
Munger even put emphasis on the key to accumulating wealth faster. He said, "Indeed, I can hear someone who has a strong desire to accumulate wealth rapidly. However, that's not precisely the approach we advocate. It's advisable to maintain an element of mystery in your endeavors, allowing room for self-discovery. While many individuals may have ideas, I've come to realize the importance of a valuable lesson. The lesson that you need to learn is that you don't need an abundance of opportunities, just a few well-chosen ones can suffice, and it's crucial not to be disheartened. When you do identify these select opportunities, it's important to pursue them vigorously." This valuable insight was indirectly imparted to Munger by a man he never had the chance to meet, his maternal grandfather. His grandfather was a pioneer who ventured into Iowa, facing challenges such as the Black Hawk Wars. After enduring significant hardships, he eventually became the wealthiest man in town, even owning a bank. In his later years, he shared wisdom with Munger's mother, emphasizing that in life, there are only a few opportunities that truly matter. This remarkable individual achieved success by focusing on just a handful of ventures. Each time there was a crisis or panic, he made wise decisions. He was selective and careful in his choices, which enabled his success. Munger believes that, for most people, finding many fantastic ideas is unlikely. While computer algorithms are powerful, they operate in a vast world where countless others are constantly seeking similar opportunities. For Munger, that doesn't seem like an honorable way to earn a living. He prefers alternative methods for wealth accumulation, such as outsmarting trading systems. Here's what he has to say about the stock market being a mania of speculation. Munger even highlighted, "I've even developed a small computer algorithm that mirrors the trading patterns of others, although I often remark that those who engage in this practice resemble rats in a grain silo. If you do choose to earn money this way, I suggest being exceedingly charitable with your earnings to offset the societal impact." In conclusion, Munger doesn't believe this ambition should be encouraged. As for the rest of us who aren't merely profiting from computer science skills, we should focus on approaches that align with our values and principles, rather than seeking quick gains in a crowded marketplace. If you're not finding it increasingly challenging, you may not fully grasp the situation.
You'll shoot your eye out, kid.
Inefficient markets. To effectively apply Charlie Munger's advice for achieving high returns on small investments, it's crucial to grasp three fundamental principles. The first principle emphasizes the significance of exploring inefficient markets. Charlie Munger, who serves as the vice chairman of Berkshire Hathaway, operates within a colossal company. Berkshire Hathaway boasts a market capitalization nearing $800 billion, making it the ninth largest company globally by market cap and the most prominent non-tech firm in the United States. While many might assume that Berkshire's massive size would confer a substantial advantage in investing, this isn't the case. Charlie Munger, along with Warren Buffett, has frequently stated that Berkshire's size hinders the pursuit of high investment returns. The rationale behind this perspective lies in the fact that Berkshire, due to its substantial financial resources, must concentrate primarily on substantial investment opportunities. Unfortunately, these larger opportunities are less likely to be mispriced or characterized by inefficiencies. smaller investments offer a higher probability of inefficiencies going unnoticed. This is where the opportunity arises for individual investors. Charlie Munger's partner, Warren Buffett, elaborated on this concept. When he began investing with a relatively modest sum of money, he meticulously analyzed numerous businesses. Out of these, he could identify just one or two investments into which he could deploy $10,000 or $15,000. These investments were strikingly undervalued, offering a compelling opportunity for profit. As Buffett's investment capital grew, the universe of potential investment ideas considerably diminished. In the past, when Warren Buffett and Charlie Munger operated with limited resources, they spent countless hours scrutinizing extensive financial reports to unveil a single prospective investment. Fortunately, today's investors benefit from the internet, which has streamlined the process of identifying potentially undervalued stocks. All it takes is a visit to a stock screener, which doesn't necessitate advanced features. A basic, free screener can suffice. What's important is having a tool that can filter stocks based on market capitalization and price to earnings, PE, ratios. By setting the market capitalization range to $10 million to $200 million and the PE ratio range from 3 to 15, you'll pinpoint small companies by Wall Street standards. Most professional investors are constrained by rules that prevent them from investing in companies below a certain market cap. For instance, the fund Munger works for in New York City adheres to a rule that prohibits investments in companies with a market cap below $5 billion. Consequently, numerous promising investment opportunities in smaller firms slip under the radar. Furthermore, companies of this size tend to lack coverage from Wall Street analysts, in contrast to larger entities like Apple, which is scrutinized by 31 analysts. Consequently, the relative obscurity of these small companies boosts the likelihood of identifying stocks that are undervalued based on their intrinsic worth. Take big swings. When a favorable opportunity arises, the rationale is that exceptional opportunities are rare. Therefore, when they do occur, it's essential to fully capitalize on them. This concept can be illustrated using a baseball analogy. For those unfamiliar with baseball, it's a team sport played with a bat and ball on a field by two opposing teams. In baseball, one team player pitches a small, round ball to a player from the opposing team, who attempts to hit it with a bat. The batter's objective is to make contact with the ball in a way that allows their team to score runs, equivalent to points. According to Charlie Munger, there are valuable lessons from baseball that can be applied to achieving success in the stock market. One of the greatest baseball players of all time, Ted Williams, authored a book titled The Science of Hitting. In this book, Williams presents a compelling illustration of himself at bat, with the strike zone divided into 77 distinct areas. Williams recognized that waiting for a pitch in his optimal sweet spot significantly increased his chances of making a successful hit. Being patient and waiting for the right opportunity yielded a 40% success rate, while impatience reduced it to a mere 23% to 25%. Williams understood that average batters could become exceptional by waiting for the right pitch, and even the best batters could become average if they swung at the wrong one.
There's no crying in baseball!
Munger firmly believes that this concept also applies to investing. As an investor, each day presents thousands of potential investment opportunities, next to pitches in a baseball game. To thrive in investing, one must patiently wait with their metaphorical bat on their shoulder, inspecting each opportunity as it arises. Only when encountering an investment opportunity perfectly aligned with one's strategy should they act, much like swinging at a pitch in their sweet spot. However, such ideal opportunities are not commonplace in investing and may take months or even years to materialize. This underscores the importance of seizing the perfect pitch when it eventually does arrive and swinging for substantial gains. This seamlessly connects with Munger's third lesson, the encouragement of a concentrated portfolio. Conventional investment wisdom suggests that portfolios should be highly diversified, comprising dozens or even hundreds of stocks. Munger strongly disagrees, deeming this approach foolish for those seeking substantial investment returns. Instead, he advocates for a concentrated strategy, where investors focus their attention on a small selection of outstanding businesses that they thoroughly comprehend. By diligently examining and understanding these businesses, investors can make more informed decisions, significantly increasing the likelihood of achieving exceptional returns. The story of John Arrillaga. Munger illustrates this point by sharing the story of his billionaire friend, John Arrillaga. It might be reasonable to assume that Arrillaga's wealth is composed of various asset types, such as owning businesses and a diverse portfolio of stocks. However, this assumption couldn't be further from reality. John Arrillaga accumulated his wealth primarily through real estate investments. Real estate is a broad asset class encompassing various categories like apartments, offices, industrial properties, single-family houses, and self-storage facilities. Furthermore, there is an almost limitless selection of locations for these real estate investments, not just within the United States, but globally. In the US alone, there are 387 metropolitan statistical areas, each representing distinct real estate markets. Within each of these areas, numerous neighborhoods offer different investment opportunities. Arrillaga, in contrast, adopted a unique and highly concentrated approach to building his fortune. He focused exclusively on real estate situated within a 1-mile radius of Stanford University's campus in California. Over 4 decades, Arrillaga adhered to a strategy of minimal debt and a pattern of purchasing during downturns and selling during periods of buoyancy. This was the entirety of his investment approach. It's worth emphasizing that despite numerous alternative investment opportunities outside the 1-mile radius around Stanford's campus, Arrillaga chose to disregard them. Instead, he remained committed to what he knew best, leveraging his deep understanding of the local real estate market. This focused strategy afforded him a significant advantage over competitors, ultimately propelling him to become one of the wealthiest individuals globally. As Munger states, if he had followed conventional financial theories of diversification, he would have been far less successful. Therefore, it's crucial to appreciate the importance of these principles in enhancing your investment expertise. It's important to know that you can always start small, and investment may be a complex process, but you can always find ways to invest in something that interests you. Most successful people start small, and if they can do it, so can you. Always remember that nothing's too hard unless you try it. If you want to learn more about personal finance and generational wealth building strategies, visit our channel and subscribe for more enlightening videos to increase your wealth.